Joining us right now to talk more about all of that is David Balan. He is the Citi Private Bank Global Head of Investments. And it's David, it's good to see you this morning.
Yeah,
Thanks
good to
so much
see you
for
too,
joining.
Maria.
We were all just talking about how the markets have been, I think you used the word underwhelming, given the fact that first we had this big rally in anticipation of the tax plan. Good economy, good market performance on the tax plan, but then all the noise around trade. Is that really what's unnerving markets right now and causing this underwhelming performance?
Yes, there's no question that that's the case. In our mid-year outlook, you take a look at the global economy, it is very strong. The tax package clearly has benefited American corporations and leveled the playing field for them. But the trade policy, when you listen to what investors are saying in Europe, the trade policy as we're currently conducting it has undermined confidence globally and also in the consistency of American leadership around that issue. And if I can be very specific, the issue that we, American corporations need to be worried about when you listen to investors is very simple, which is protecting our intellectual property rights and getting access, in this case, to Chinese markets. We do not have the same issues with Germany or Canada. Aluminum and coal issues are not as substantial as our intellectual property rights, which is the future, of our economy. And so that, I think, is really upsetting investors globally.
David, if you look at the market performance for the rest of the year, because we're sort of at the halfway mark, is the strength of the U.S. dollar going to be a drag on corporate earnings since so much of the revenue of the Fortune 500 is earned abroad?
It depends on whether it stays at this level or goes higher, which is not what we expect. In our mid-year outlook, we're expecting the dollar to begin declining at some point over the course of the year. So the answer to your quick question is no. We expect earnings to continue to be at double-digit paces, but we expect modest increases in equity prices from here, about 6% in the U.S. And our clients' portfolios are overweight outside of the United States. We think that buying on weakness in the emerging markets and in China itself is actually a good investment opportunity.
We should point out that in the first quarter, we get the final reading on gross domestic product later this morning. 2.2% growth expected, but the GDP now, which again from the Atlanta Fed changes moment by moment,
Right.
but right now it's forecasting 4.5% growth in the second quarter. So at least in the short run, the danger of tariffs is not showing up in economic growth, although we have a lot of groups warning about it wiping away the tax cut.
Right, and that's exactly, so in a macroeconomic policy, that's correct. What investors want, and in my mind, is that if you think about just where we were 3.5 months ago, we were in a situation where we were having global growth, we were having an opportunity for the markets to expand, for U.S. Stock prices to be up 10%. And so what the market is telling you is that uncertainty around tariffs is actually not in the greater interest of our market or the global markets. What I think investors need to do is to think about two things. One is to stay fully invested regardless of market volatility, and two is about cash. Investors have an extraordinary amount of cash that they are simply undermanaging. The average retail investor has 15%. The average wealthy family has 25% of its assets in cash at a time when rates are rising. And so there's a huge opportunity for them to actually make more money on the assets that are sitting idle right now.
One thing I just want to add, because I alluded to it, just yesterday, the Alliance of Automobile Manufacturers, which represents all auto manufacturers, said that a 25% tariff on auto imports would amount to $45 billion in a tax on consumers and would wipe away the benefits of the tax cut on low and middle income Americans. So there are warning shots being fired by companies, individual and even industry groups.
That's exactly right. And the question is to what end, right? If tariffs are being used strategically to change policy with China, fair enough. But at the end of the day, what is it doing for the average consumer in the country? And the answer could be quite negative.
So here we are. We're just a few days away from the end of the first half. Characterize what you've seen this half and what you want to see, what you think you'll see in the second half of the year. Then.
So if a client had a dollar at the beginning of the year and they woke up on June 30th, they'd have $1.01. They'd have made a penny. The ride has been awful. They've had several corrections, and the uncertainty in the future is extremely great. So what we see for clients going forward really depends to some degree on this international policy. But looking just at fundamentals, just at the data, you have to want to be an investor in this environment. You have to want to sit through the volatility. We're overweight equities still, although predominantly outside of the U.S. And our clients have invested, Maria, $5.5 billion more than we expected since the beginning of the year in net globally, because at the end of the day, the ability for them to make profits in the market with interest rates this low, no matter how high they go, they're still going to be half of what they were at the peak of the last last interest rate cycle. this is a time for investors. If we can get rid of this noise and if these trade issues can be resolved, it will be positive.
You said 25% you said families have 25% of cash.
Ultra high. So the average retail investor has 15% in cash. The average ultra high net family, 25% in cash, and they've held that since 2009. It's a huge drag on their total returns.
Yeah.
So what we're advising our clients to do is to really manage their cash, taking advantage of these, shorter term rates that are very high and great municipal bond rates.
But if you're super rich, you can just sit on cash. You don't need to make money in the stock market. It's the people who need a retirement nest egg. You build it by investing. But if you're rich, it's like, hey, I can just sleep on it, put it in a mattress.
It's funny, but I sort of think about this from my dad's perspective, from our client's perspective. Would you rather make 2.5% on your $100 million or 2.5% on your $100,000? Yes. The thing is that people are literally making nothing or 25 basis points, and that's what really we're talking about, is this idea of managing every dollar that you have, whether you've got $1 or $1 million, managing it wisely.
Well, it's been the case for a decade now.
Exactly.
And bottom interest rates, making no money in savings. Real quick, if you had to put some of that cash to work in equities, are there areas in equities in the U.S. that you like particularly more than others?
Yeah,
for example, technology has been...
There's a huge difference between growth, which is the big story, and tech, which is the big story, and companies that are wildly well valued today. So if you look at some of our cities' programs and our recommended programs, we love pharmaceuticals with 4% dividends and strong drug pipelines. We love certain basic industries and consumer industries which have really gone down in price hugely, even though due to margin compression, but they have great growth prospects and high dividends. So there are good things to buy in America. We're neutral on it. We want our clients actually to buy, though, foreign stocks and even invest in China as the market dislocates, because over the long term, just to give you a number, America is 5% of the world's population and 50% of the world's market cap. If you take a look over the longer term, putting money, whether it be Brazil or China, makes sense given where the demographics are. So we think that that's a good long-term play.
And real quick before you go, to Dagan's point, do you foresee an economic slowdown out a couple of years? When does that recession start? When does that slowdown start in your mind?
I mean, again,
2020
ex-trade, we were about 2020, and one of the reasons why markets are becoming more uncertain is because that could be moved in. And so but no matter what, we want clients to keep their portfolios fully invested.
All right, we'll leave it there. David, great stats from you today. I'm loving all your stats. Good to see you.
Thank you.
Thanks so much. David Bailyn from Citi.